Hello and welcome to our conversation on financial reporting and analysis. Today we will try to understand and examine um, common size financial statements by picking up two companies, one loss making company, another profit making company. But the common size financial statements can be common size balance sheet as well as common size income statement. Let's just get an recap. What do you mean by common size balance sheet? A common size balance sheet is a balance sheet that shows the relative percentage of total assets, total liabilities, and total equity. And these are used by the analysts, both internal and external, and normally they are not a part of the generally accepted accounting principles requirement. Similar is the case with the common size income statement. It shows the relative percentage of all income, expenses, and the profit. In order to understand how the common size financial statements help in throwing light on various aspects of the business, let us pick up the financial statements of balance sheet and income statement of a profit-making company, which is Power Trading PTC India Limited. PTC, which formerly known as the Power Trading Corporation, and it was incorporated in 1999 for undertaking trading of power. So therefore, because it is in a trading of power, normally the business is not very complex and it is a reasonably profit-making company. Can be called known to be a profitable company. So let us see the balance sheet of Power Trading Corporation or PTC India. We collected this balance sheet from moneycontrol.com, and you can see the balance sheet as usual will have number of items, will have several sources and equity and liabilities and different types of assets. Before we convert the balance sheet into common size balance sheet, let us first convert that into a condensed balance sheet, which will show some important items without compromising on the total of sources and total of assets. So therefore, let us first convert the balance sheet into a condensed balance sheet showing equity, non-current liabilities, current liabilities, non-current assets, and current assets. So as a result, we get a fairly good idea about what is the direction this particular balance sheet or this company is actually taking. You can see from this condensed balance sheet, the equity of the company has been rising from 2,790 crore to 3,513 crore. The other than that, the liabilities and the assets positions are also very clearly given without getting into the nitty-gritty of the balance sheet to start the conversation. And this balance sheet can be converted to common size. That means every item is converted into a percentage of the total sources or total assets. So you can see that the common size balance sheet converts equity as a percentage of total source, converts the assets as a percentage of total sources. So we get a fairly good idea about the changes in the equity, changes in non-current liabilities, changes in current liabilities, similarly the current assets and non-current assets. So a common size balance sheet is therefore converting the normal balance sheet into a relative an item relative to the total balance of the total assets or total sources. It is not necessary that we have to convert a condensed balance sheet into a common size balance sheet. If you want, we can also convert this balance sheet into common size also, okay? So every item of the balance sheet can be converted into percentage of the total assets or total sources. But as an analyst, it's not a bad idea to get a fairly broader picture first, then drill down and examine those items by getting into the balance sheet and sometimes getting into the income statement to examine the changes in the balance sheet. Let us see the important items of the balance sheet and the common size balance sheet. We can see that the Power Trading Corporation or PTC India equity all through has been positive. So therefore, last 5 years, equity on average accounts for 50 to 40 to 50% of the total sources. So the equity as a percentage of total sources come down. That doesn't mean that equity in a value has come down. The equity as a total value in absolute figures have gone up because let us see the equity. What is the equity consist of? Equity is 40% of the source, and equity consists of capital and the reserves. And the capital has not changed, did not change during these 5 years. So the reason for the change in the equity is because of the reserves and surplus. And the reserves and surplus has changed because of the profits of the company. But why did the equity as a percentage come down? Because the liabilities have gone up. We can see that current liabilities have increased from 44% to 60%. Now let us see what is this current liability. So 2,166 crore has become 5,300 crore. What is the business of PTC? PTC normally buys and sells power from the purchases power from the generating companies, sells power to distribution and any other buyer. So therefore, if you examine the composition of the current liabilities, the composition of the current liability to a large extent is the trade payables. Trade payables means the money that they have to pay to the generating companies maybe. So therefore, the increase in the current liabilities is responsible for increase in the liabilities of the company. But where is the money going? We can see the composition of the assets. The current assets account for 81% of the total assets, and non-current assets account for 19% of the total assets in the year March 20. So what does that mean? Because this reflects the nature of the business. Our PTC is not a manufacturing company. PTC is not a generating company. PTC is only a trading company. So no wonder the fixed assets or the property, plant, equipment or non-current assets will be relatively a low percentage of the total assets. So 81% of the assets are current assets. See, the current assets has increased from 4,020 crore to 7,141 crore. Now let us see what are these current assets. I'm sure by now you may be guessing it that too correctly that this is a trading company. So the current assets will be definitely a significant part of it will be receivable. They sell power to various buyers, including the distribution companies, and the trade receivables have increased from 3,000 crore to 6,788 crore. So therefore, the common size balance sheet gives us a very larger, at a macro level, the percentage of individual items to the total assets and total liability, total sources. But how will this be meaningful? How will this common size balance sheet be meaningful? If you want to compare PTC with a non-related company, let us say, suppose we pick up a loss-making Videocon. I hope you all know that Videocon is going through a tough time. It is has been referred to the IBC, and see the Videocon's balance sheet. We can see that Videocon equity over a period of time has become negative from 27% to -9%, whereas the equity of Powertrain PTC is all through has been positive, all through has been positive, because the reserves are all through positive, and not only positive, they're also increasing over a period of time, right? Reserves are increasing over it. Whereas the Videocon, the equity has been decreasing and has become negative because the equity has decreased from 10,000 crore to minus 2,636 crore. And why this minus 2,636 crore? We can see that the reserves have been continuously falling and has become negative. So the fall in the equity is due to the reserves. In this case, the rise in equity is due to the reserves, increasing reserve. And that is visible through the common size balance sheet. So therefore, as a first step of any financial statement analysis, it makes sense to convert a balance sheet into a condensed balance sheet and convert that into common size. But if you want, you can also convert that into a common size, the detailed balance sheet. There is no hard and fast rule. This is not a gap-driven exercise. This is the need of the analyst. Now, the same balance sheet can also be further condensed with a focus on, let us say, capital employed. Capital employed is a long-term source of a company. The long-term source consists of equity and non-current liabilities. You can see that PTC has not been depending on the loans. PTC is having positive equity, so the capital employed has increased because of the equity. If you want to convert this into a common size balance sheet, which is possible, so what we can do is convert every item of the common size balance sheet as a percentage of capital employed. Every item of the balance sheet as a percentage of the capital employed. Okay, so we can get an idea here that the total to a significant portion of the capital employed is the equity. A significant part of the total capital employed is equity. Now convert that into the common size balance sheet. So the capital employed based condensed balance sheet can also be converted into a common size. So every item of a balance sheet here, for that matter, any balance sheet can be converted into a percentage of total assets or total sources. The advantage of common size balance sheet, as we mentioned a few minutes back, that it shows the relative percentage of the important items of the balance sheet. What is the relative percentage of assets? Within the assets, what is the relative percentage of current assets? What is the relative percentage of current liabilities? Okay, so we can see that the common size balance sheet is possible to be, any balance sheet can be converted into a common size balance sheet. Now we can further condense it this way. We can further condense the balance sheet with a focus on the equity. Equity is equal to total assets minus total liabilities. So equity is equal to total assets minus total liabilities. This balance sheet or capital employed balance sheet or the total sources and total sources and total assets liability balance sheet all can be converted into the common size balance sheet. Let us see the capital employed of Videocon. Let us see the capital employed of Videocon. We can see that capital employed of Videocon has become negative over a period of 5 years. Why it has become negative? Because the equity has become negative. And significant part of the liabilities is because of the current liabilities. And why it has become negative equity? Because the company is not making profit. So 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 therefore the comparison of two unrelated companies which are not from the same industry, two different, the companies are two different sizes, two different types of ownership, can also be compared the moment you see the prepare a common size balance sheet. Can we prepare the same concept can also be used to see a common size income statement or a profit and loss account. But just the way we did for the balance sheet, a common size PL account, it also makes sense to convert a detailed income statement into a condensed income statement showing the top line and various types of the profits: EBITDA, EBIT, PBT, PAT, and earning per share. So, and all these items, unlike the balance sheet in the common size, in case of a common size PL account or a common size income statement, every item is converted as a percentage of total income. So, operating revenue of Videocon accounts for 94% of the total revenue. But why there is a loss, right? You can see that the loss of the company has been rising continuously. And the loss is due to the fall in the revenue. And because the revenue has been coming down, we can see that interest, which is accounted for 18% of the revenue in December in the year 2015, has actually become 300% in 2019. And so a common size balance sheet can actually tell us which item is responsible for the loss. So whether it is a common size balance sheet or a common size income statement, they enable us to get a fairly larger picture about the company as a whole. And that common size balance sheet can be used to undertake an intra-company analysis, can also be used to undertake an intercompany analysis. What does that mean? I can undertake the analysis over a period of time. Okay, over a period of time. What is the composition of the equity? Okay, so that is the intra-company analysis. Compare Videocon with PTC is the intercompany analysis. So common size statements, therefore, are a very useful tool in the hands of the analyst to undertake both common size and the comparative, both intercompany analysis and intra-company analysis. So that is that brings us to the end of this session. Thank you very much.